Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink CYDVF, and on Frankfurt C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob, and welcome to what is a very sunny day in Vancouver. Something rare.
Lovely. Friday. Great.
A Friday
wonderful.
And sunshine. Yes.
And, well, it's been an interesting week. And it's in what the street calls earnings season. So it's earnings come in, of course, with a good economy. The earnings have been great, and I guess maybe some of the lower taxes are in the U.S. are kicking in. But and it was Tuesday, I guess it was, where the earnings were just so good that stocks were very strong, and the huge producer of equipment, Caterpillar stock, CAT, had a great earnings, and stock went up. And the close the day before was like 156. In the opening, it was up to 161. And then in an instant, down to 142. And then closed at about 143. So, big cap stock like that, important company globally, and the bids were so strong and impetuous, and then all of a sudden they were in and filled, and there were no further bids, and for some reason or other, all of a sudden the selling came in. So now that it was part of the move in the index as well. So this got us onto a theme about pitfalls in the marketplace, which are sort of like a trap door, and you see them in the movies, used in combat. And they're by nature a surprise if you're the person walking across the trap door when it lets loose. So this is a real heads up on it, Jim, because you had changes with other things going on. Interest rates got a little higher, but then they've been rising for some time. And but within it was that the U.S. dollar index, the DX, firmed up. And we've been watching the DX for about 5 months now. It's been building a base, a long one. Well, first of all, it came down very hard and created some technical excesses like downside capitulations and sequential buys. And then we thought, well, let's see when there was a previous major bottom on the U.S. dollar, and that was in 2014, and that took 6 months. And then the one that really caught our eye was the bottom in 2008, and that one took about 5 months. But after all this churning around, the key to the turn to rising in the dollar was breaking above the 20-week exponential moving average. And that occurred this week. And the dollar has continued up. The base was done at around, this is the U.S. dollar. The base was done around 88, 89 from January. And then just last Friday is when it poked above this 20-week moving average. And that was at 89.75. And now it's up to 91.36. So it's been a very good week for the U.S. dollar, and this, of course, is in the face of a lot of bearishness out there on the dollar. Jim, this is interesting because this is the one thing that central bankers and gold bugs get together on, has said the central bankers think the remedy for any problem in the economy is to depreciate the currency. And of course then the gold bugs look at the central banker, in this case the Federal Reserve, and say, oh, they're crazy. And of course I agree with that one. And then they say, of course, their recklessness is going to drive the dollar down, and that will drive gold up. And if you're a silver bug, of course, silver will go higher. If you're a crude specialist, then it'll drive oil up, and if you're a base metal specialist, it'll drive the base metals up. But the point is that the public chooses what would be speculated in. And since 2011, which was the huge speculative high in the precious metal sector, it's been a downhill trip for that, and because it was, a fabulous bull market in the financial sector. And this is the way history has worked.
We'll have more with Bob Hoye right after this.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the U.S. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the U.S. and GET in Canada. Find out more at glancepay.com.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp. Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
Welcome back. We're chatting with Bob Hoye. Bob, the Royal Bank of Canada says it's going to raise its fixed mortgage rates by 20 basis points of April 30th. So much for the Bank of Canada not raising rates.
Yeah, you've had, in, let's call them market rates of interest, and that's where, like Canadian T-bills or U.S. Treasury bills, they trade all the time, and they go up and down in yield. And they've been going up in yield quite strongly. As a matter of fact, very strongly. It's got the strongest rise in the T-bill rate since 2006. And the way we look at interest rates is that if, like the instrument, the T-bill rate is going up, it means the party is on, and it goes up with parties. And what you want to worry about is when the T-bill rate turns down, and it rose up very strongly to this, early in the week. Now it's backed off a bit, but anyways, the Bank of Canada sets what's called the administered rates, and the central bankers really believe that the rest of the world all follows their rise in interest rates. But if you take a look at financial history, look at the charts, and mainly we stay with the senior currency in the economy, which is the U.S., and for 100 years, the history is that at major turning points in interest rates, either up or down, the central bank has been behind, 4 or 5 months behind the major turns. So whether it's turning to go up in a boom or the start of a boom, or turning to go down with the start of the contraction. So this has been an unbelievable promotion where these guys have got together and said, hey, we're geniuses if we can manage the economy by fiddling around with interest rates, and fiddling around with foreign exchange values. And really all they're doing is following the natural changes in the business and credit cycle, and how they've got away with the scam for so long. But then you've got, generations of people who have taken degrees in economics, and most of which is interventionist economics, and they got a vested interest in all this stuff. But every once in a while, well, let's just step back to the formation of the Federal Reserve in the early 1900s. And one of the reasons for reintroducing a central bank to the U.S. was that by being a lender of last resort, it would prevent the financial upsets that typically precede a recession. So that was one of the main pushes behind forming the U.S. Central Bank. And it opened its doors in January 1914, and there's been 18 recessions since. So on their own claims, it just does not work. And here we are now. We're in where the part where the boom has become impetuous. That's both in the financial markets and in, business. And you're seeing headlines about people, businesses ordering huge trucks, and you've got great price changes in houses and things like that. So, it's a boom. And there are certain patterns that show you that the boom is exhausting. And one of them is exceptional readings in the stock market, but then underneath it you've got changes in the credit spreads, which is the difference between high-grade bonds and low-grade bonds. And for the last few months, this has been favorable. And you also get the changes in the yield curve, which is the difference between long treasuries and short-dated treasuries, and that has been positive as well. So we're watching these things for change, and at the moment they're sort of positive. But what we're dealing with, Jim, is that the boom in the financial side has been the greatest bubble in history. And financial bubbles start in the early 1700s in England with the South Sea Bubble in 1720. And they have very common characteristics. So that bubble, back in October, we figured that the whole world was going to get bubbled, including, as we quipped, even the Dow Jones. And then the next thing on that was, when have strong markets concluded in the past? And that was in the December-January window. Gold in 1980, the Nikkei Tokyo, fabulous speculative market in 1989. That was the last trading day of the year. So there are some examples. So we thought maybe the bubble would conclude in the December-January window. And for that conclusion, you'd have to have straight-up stock markets in that window, which happened. So then the call was, watch out. And so we've had a hard hit, and then some real choppiness in the senior indexes. And the thing right now is that what we were looking for would be, and we called it some sunshine in the credit markets. That would be favorable action in spreads and the curve, and that's happening. So we can say that we're getting the sunshine we needed, and that has been helpful for the rally until Tuesday, when all of a sudden you had that huge reversal, which I say is a heads up on the ability of the operators in the stock market to keep the thing going up. So there are things to watch yet, Jim.
We'll have more from Bob Hoye, plus a listener question when we return.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, we have a lengthy question from a listener, but basically I think the gist of it is, with so much government debt and increasing interest rates, will they have to raise taxes to pay their debt fees? And what will that do to the economy? Plus, is there any solution to it?
Makes sense. They'll have to raise. Here's the theme. Interest rates were exceptionally low. They've been rising. Governments have exceptionally huge debt burdens, and just the cost of servicing that goes up as you see interest rates go up. And of course, they faced this before. After the Second World War, the interest rates were at a secular low then. I think the low for the long bond was about 2.5% in 1946. And then rates started to go up. And then as they approached 3%, that's, half a point difference increase. It was easy to say, look they had that huge war debt, and then the cost of servicing it. So they then thought, here's the idea. What we'll do is keep interest rates from rising. And the Treasury, U.S. Treasury, started buying bonds out of the market to keep them from rising above 3%. Then in the 1960s, Jim, you won't believe this one, when the interest rates were at 6%, that's for the long Treasury, they then said, well, we're not buying enough bonds. So they came up with a promotion, they call it Operation Twist, where they were really going to buy bonds and keep rates from going above 6%. Well, what they were doing is buying bonds was injecting a huge amount of cash into the economy, and so much so that prices went up and then the purchasing power of the dollar went down. So that's the classic inflation. So what happens then? Interest rates go up to adjust for the loss of purchasing power. So then the attempt to hold at 3% didn't work. The attempt to hold at 6% didn't work, and it went right up to 15% in 1981. It's the highest interest rates in the senior currency have ever been, and that's going back to 1700. The high hitherto was sort of like 6.5%, and here, on their effort to lower interest rates, they drove them up to 15%. Now, to get to the question, is interest rates are going to go up? Yep. They're going to go up further, and that then is the same problem. So they may wish to raise taxes, but you have a popular uprising going on against the excesses of government. So raising interest rate or raising taxes in the U.S. is going to be unthinkable. And then the other way that they have funded unlimited government is through unlimited issue of credit. And if the credit markets contract, then that is improbable. So to sum it up, Jim, there's no way out. I think the uprising will curb the expansion of government. And with a recession, the folks are going to look at the promises of government that they took all these trillions of dollars of taxpayers' money and threw them at the financial markets to prevent bad things from happening. And if you're in a recession, a bad thing is happening. So the public is in a mood to be critical, even of experts. So, yeah, no way out. and I think it'll add to the success of the popular uprising in trying to curb government excesses. Very exciting times, Jim. I'm glad to be vertical during this period.
Bob, thank you so much for chatting with us.
Jim, always good, and we look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com Radio. Our YouTube channel is Talk Digital Network. Questions for Bob or any of our other guests can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of Howe Street Media Incorporated.